Soft data, a weaker dollar, and growing credit tensions are pulling asset classes in different directions today. This is vTalkInsight, Allocator's lens daily for July 6th, 2026. Across equities, rates, credit, foreign exchange, and commodities, the key question is whether the soft landing backdrop can coexist with rising medium-term risks from politics, refinancing, and geopolitics. We begin with equities, where earnings strength is still doing most of the heavy lifting. In equities, the dominant theme is how gently softer U.S. data is reinforcing a risk on tape rather than breaking it. Weaker payrolls and signs of cooling inflation have pushed back expectation for the next Fed hike and lifted confidence that the economy can slow without stalling. That combination matters because it allows equity markets to interpret bad news as good news for policy, at least for now. U.S. equity benchmarks are benefiting from strong corporate profit growth, supported by AI-driven investment, loose fiscal stances, and healthier net exports. Earnings delivery has allowed indices to look through the softer jobs numbers and treat them as confirmation of a soft landing, rather than as an early warning of recession. For allocators, that earnings cushion is central to why risk assets have digested the latest data so well. Leadership is also broadening beneath the surface. Small-cap stocks have quietly outperformed large caps for nearly a year, and sectors like healthcare and consumer staples, which trade at relatively low valuations, are starting to attract more interest alongside the dominant tech and memory chip complex. That widening participation reduces index concentration risk, even if the headlines still focus on a handful of mega-cap names. Regionally, Europe has taken the lead this year. European indices have outpaced the S&P 500 year-to-date, with gains widening for financials and industrials into staples, healthcare, basic resources, and parts of technology. A busy pipeline of initial public offerings, especially in tech and defense, and sustained government spending in aerospace and security are all feeding into that more constructive narrative. At the same time, there are clear pockets of caution. Utility stocks are currently the best-performing sector in Europe, hinting at a defensive tilt beneath the headline risk-on tone. In AI-linked trades, equity market optimism looks exuberant even as corporate bond spreads in the same sectors remain elevated and alternative asset managers have come under pressure following a sector downgrade. There are also structural questions around the sustainability of current leadership. The AI capital expenditure boom is broadening toward global data centers and Korean memory names, but the largest cloud and platform companies are shifting from highly cash-generative toward more cash-consumptive models. That raises doubts about how far tech valuations can stretch into the second half without clearer evidence of durable free cash flow. Political and fiscal risks round out the picture for equities. French election uncertainty, UK tax debates around logistics warehouses and data centers, and ongoing questions over U.S. central bank independence could all inject volatility, even as equity volatility gauges remain in the mid-teens. For now, earnings strength and abundant liquidity keep the tape supported, but the degree of sensitivity to policy missteps is rising, which brings us to the rates backdrop. In rates, the immediate story is the market's growing conviction that the Fed can stay on hold for longer. Softer non-farm payrolls, decelerating job growth, and evidence of cooling inflation have led traders to mark down the odds of another hike this month to roughly 1 in 5, with some now pushing any move out toward year-end. That repricing has eased front-end yields and encouraged a gentle bull steepening of the curve. Lower expected policy rates are reinforcing the soft landing narrative that underpins risk assets, while earlier declines in oil prices made it easier for the Fed to justify patience. The latest shift down in rate expectations is feeding directly into equity rallies, tighter credit spreads, and a weaker dollar. Even so, the policy outlook is far from settled. Deglobalization, AI-related capital expenditure, and the risk of renewed energy shocks from choke points, such as the Strait of Hormuz, all represent medium-term inflation risks that could force central banks to lean tighter. At the same time, political pressure is building, with open talk about reshaping the Fed under a potential Trump presidency and intense scrutiny of the search for a new Atlanta Fed president, where some prefer candidates seen as more corporate and potentially more dovish. Across the Atlantic, the picture is even more nuanced. European growth, inflation, and rate paths remain uncertain, and some policymakers still flag the possibility of another European central bank hike as inflation stays above target. German two-year yields around the mid-twos reflect that lingering hawkish bias, while French government bond volatility is likely to increase into elections and difficult fiscal negotiations. The UK yield curve also looks fragile at the long end, where investors are wary that higher borrowing may not translate into stronger productivity or trend growth. Together, these dynamics suggest that while near-term rate expectations have turned more dovish, structural term premia linked to geopolitics, deficits, and supply chain rewiring may stay elevated. That tension between easy policy hopes and higher funding costs is already visible in credit. In credit, the surface still appears calm, but the undercurrents are becoming more complicated. Public bond markets remain well supported, with generally tight spreads and limited signs of broad-based default stress. Yet the signals from private credit and shorter-dated corporate borrowing are more concerning. Private credit funds are experiencing a sustained wave of redemption requests. More than $14.5 billion of investor capital is now gated, and exit queues continue to grow in the second quarter, with some vehicles indicating that full redemptions could take up to 2 years to process. Retail-heavy products, particularly those sold through aggressive wealth channels, have seen the sharpest outflows and have had to lean heavily on gating provisions to manage liquidity. So far, performance across much of private credit remains robust, with spreads still tight and few signs of underlying asset stress, which suggests current issues are more technical than fundamentally driven. Managers with diversified, counter-cyclical strategies appear to be facing fewer redemption pressures than more narrowly focused, software-centric peers. Even so, there is an underlying concern that value destruction could emerge over a longer horizon. Many companies that locked in very low coupons in 2021 will confront meaningfully higher borrowing costs over the next 2 to 3 years, and default risk in shorter-dated corporate financing is already edging higher, especially in parts of the private credit universe. Within AI-linked sectors, the divergence between equity and credit is particularly stark. Equity markets are pricing in an aggressive growth story, but corporate bond spreads in those same industries remain elevated, signaling far more caution from debt investors. Alternative asset managers have also come under pressure following sector downgrades, reflecting worries about leverage, liquidity, and the durability of fee income. Taken together, credit remains supportive for now, but represents a key fault line in the otherwise upbeat macro narrative. If growth slows or refinancing challenges intensify, today's technical liquidity issues could evolve into more fundamental stress. That makes currency markets an important barometer of how policy and risk appetite are interacting across regions. In foreign exchange, the softer U.S. data and repricing of Fed hikes are finally taking some pressure off the dollar. A weaker greenback, combined with reduced expectations for imminent tightening, is feeding a more positive tone across currencies, commodities, and equities as crowded long dollar positions are pared back. One immediate beneficiary has been Asia. Korean equities are rallying on renewed enthusiasm for memory and AI supply chains, and from Monday the won is set to trade around the clock as part of a major reform of Korea's currency market. That shift is designed to deepen liquidity, attract international investors, and support the country's bid for developed market status, all of which matter for allocators considering unhedged regional exposure. At the same time, yen volatility has picked up sharply. Recent swings in dollar-yen reflect not only policy divergence, but also a reported shift toward more unpredictable, ambush-style interventions by Japanese authorities. That raises the risk for carry trades funded in yen and complicates hedging decisions for global investors with Japanese assets. Beyond the major pairs, FX remains a key transmission channel for geopolitics and resource shocks. Transit fees through the Strait of Hormuz, shifting energy routes from Gulf exporters, and ongoing tensions in economies, such as Cuba, all feed into current account balances and sovereign risk premia, particularly for energy importers. For now, currency markets broadly echo the risk-on tone in other assets, but the mix of policy divergence, intervention risk, and geopolitical crosscurrents argues for a highly selective approach, which is also evident in commodities. In commodities, the balance has tilted back toward disinflation, but with visible tail risks. Earlier disruptions around the Strait of Hormuz pushed oil prices higher, lifted production costs, and shaved global growth, contributing to a temporary bump of roughly 1 to 2 percentage points in inflation. Recent stabilization in that corridor has allowed some of those pressures to ease, particularly for Europe, where the resolution of the immediate energy crisis is reducing near-term macro risk. Even so, key shipping lanes are unlikely to revert to their old cost structure, as transit fees to Iran and Oman look increasingly entrenched and major Gulf exporters invest in alternative routes via the Red Sea and ports such as Fujairah. Those changes raise the baseline cost of moving energy and goods, embedding a structural element of inflation risk even when spot oil prices are relatively calm. At the same time, a softer dollar and diminished expectations of fresh Fed hikes are lifting sentiment across the broader commodity complex, with higher gold and silver prices feeding through to resource equities and selected European basic resources names. Looking further ahead, climate and resource constraints are reshaping the commodity opportunity set. Water scarcity in Europe and the Middle East, plans to replace a third of imported fuel with biomethane in France, and large-scale investment in water recycling and strategic minerals all point to an ongoing energy transition that will continue to intersect with inflation, growth, and geopolitical risk. Those crosscurrents bring us back to the overall multi-asset picture. Across assets, today's message is that the soft landing narrative is still intact, but it rests on increasingly uneven foundations. Equities are enjoying strong earnings, broadening leadership and supportive rate expectations, even as AI exuberance, political risk, and sector-specific downgrades remind us that positioning is crowded in places. Rates markets have swung toward a more dovish view, yet structural forces from deglobalization to fiscal deficits and shipping costs could keep term premia elevated. Credit looks calm on the surface, but is absorbing mounting liquidity and refinancing risks, especially in private markets. FX and commodities reflect a weaker dollar and easing energy pressures, but also highlight how quickly geopolitics could reprice inflation and volatility. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.